Good morning, everybody. It's been a crazy few months, and just wanted to make sure that you know where we stand, where I stand as your advisor, and what we're looking at, what we're seeing now, and just give you some information that hopefully can help you sleep better at night. Know that we're on top of everything as best as we can, and even though everybody is dealing with this virus differently, um, my family is okay. I'm able to work and operate as normal. Sometimes I'm in the office, sometimes I'm at home, um, but I have not really stopped. So that's something that I think should be a good positive for you to know that, we're not taking time off here or ignoring or letting your portfolio or hard-earned assets just, you know, go by the wayside. So just wanted to get that out of the way and cover a few things that we think are important, particularly given the investing environment right now, all the crazy headlines that come out, and just kind of go a little bit into the behavioral side and what we think we should be focusing on. So I have some slides here from a few different sources, and City National Rockdale is one of our brightest groups that we follow, and they manage all of our high net worth clients, well, most, and they're extremely trusted in the investment world, and we have a great relationship with them. So they came out with a great piece yesterday called Perception versus Reality, and they covered, the markets, behavior, the virus, and things that they're doing for portfolios. So I just wanted to go through a few of these slides just to drill into our minds some of the things that we should remember, no matter what we hear, whether it's TV or news or social media. So let's just go right into it right now. There's about 31 states that are reopening in some form. Doesn't matter what your opinion is on this, it's happening. And in a few months, we'll know whether it was a good decision or not. But there's cases on both sides. I won't tell you my personal feeling because I like you all too much. Job losses are very high. The new report came out today, about 2.9 million additional. Unemployment will be over 15%. Doesn't look like that's going to hit the bottom until about June. And then the summer, all bets are off. In the fall, there's already some schools that have announced virtual only. So we'll just have to see what happens. Some bright spots, though, 80% of states are at or near adequate testing. So this is something that plays around in the media and with our minds on this virus of optimal testing, adequate testing. Does every single person need to be tested before we're confident enough to walk out of our house? So we just have to be careful of how we're viewing the rules of what were initially laid out for how we were going to treat this virus. And I'll get into that a little bit later. Right now, stocks in the US are down about 11%, make that 15% with the last few days. Today, no surprise here, the Fed is getting pessimistic. The House of Reps is looking for another stimulus package. So could go either way here. Stimulus looks like it provided a lot of support back in March, and we saw the market bounce back. But there's still a lot of small businesses and unemployment that somehow have to work its way through the market, and we'll see how that plays out going forward. Go to the next page, and this is just a look at, on the left we have U.S. large cap down as of 5/12, 11%. Europe and emerging markets doing much worse, and that's nothing different than what we saw the last few years, where the U.S. was the strongest market, and we expect that will continue. So it's not to say you want to avoid all these other areas entirely. Diversification plays well. Europe has plenty of dividend stocks that should perform and be longer term holdings. But just wanted to point out the US is faring better at this point. So there's studies out there that go into behavior, and this is what I wanted to focus on. It's pretty important, where we look at different biases that we have, and just want to be careful that we don't put too much weight into any one of these. And if you look at the top left, the stock market goes up, and it's a no-brainer. Everyone should buy this stock, and that has no bearing on what could potentially happen in the future. And then someone comes out with a negative article, but because I don't agree with it, I'm going to disregard it, and I'm going to find a different article that confirms what I think is right, that stock from before is a perfect bet. And then it tanks. And we go to hindsight bias and we say, everybody knew this market was going to correct. How did we not see that coming? And then further down, we have what we call loss aversion bias, which is one of the big ones, where now we're so afraid that we lost some money, we're just going to wait, and we know exactly when the bottom is going to hit, and we'll get back in because we're just going to wait. It's just too negative. And now the market comes back like we saw in late March, early April, after a 30% downturn. And, the bull market's back. Let's put all our money back to work. That was the bottom. We have no idea if that's really the bottom. But these are just some of the things I want you to be mindful of, that are how our minds perceive the information that we're given. And, we're in this for the long term. So we don't look at any 1 week, 3 week, or even, 6 month period as this is all of the facts and this is exactly how the market's going to play out. So just wanted to make sure, we're aware of this, because our minds are always going to work this way. It's just up to us to be disciplined and strong enough to know that it's happening and talk ourselves out of it the other way and turn off the emotion. I'm going to skip down again about the headlines to give you our opinions, which we agree with City National on this, about reopening. And the headline says, when New York is removed from the data, cases are increasing around the country. It's crazy. How can Florida open? How can Georgia open? Their cases are out of control. Well, if you look at the left, the weekly new cases, the red line is everywhere in the US except for the tri-state area. And that is a true statement. Those cases are rising. New York, New Jersey, Connecticut look like hit their peak and are on their way down. But although that statement is true that cases are rising, look at that right-hand chart. So on the right-hand side, are those cases rising because all of a sudden there's this brand new epidemic and this spread that they don't know where it came from outside of the tri-state area? Or is it because they've ramped up testing significantly, so now they just know more of the existing cases that are there? And that's what we think is the answer, is cases are up because testing is up, not because there's new infection spreading that nobody knew about. So just our opinion there, but we think we need to just be careful when we hear things in the media. So now when we look at positive test rates, about mid-April, we started to see those numbers come down for New York, New Jersey, Connecticut. But other than New York, New Jersey, and Connecticut are well above this 10% level. But everywhere else, including all the states outside of the tri-state, where all these cases in the media are cropping up and the epidemic's crazy, they're already below 10% for positive test rates. So if it can be contained and we have coverage in our medical system, it's okay to start living our lives and deal with some risk. Doesn't mean we're insensitive or we don't care if people die, but there's risks in everything we do. So we just have to make sure, are we capable to deal with the downside? And do we know that we have medical equipment, we have PP&E, we have beds. We don't, in the last minute, have to send a Navy ship to have people get treatments. I mean, that was crazy. But it seems like below 10% should be good news for most places. So that gets back to the original goal, according to Dr. Fauci and everyone else, was if we don't lock down, we're going to have this blue curve where we're not going to have any availability in hospitals, and incredible numbers of people dying are going to take place. So if we can wear masks, if we can self-quarantine, if everybody can stay at home, then we can lower this curve, and we can have this yellow bar, this graph, be below this dotted line so that our hospitals have capacity. That was the goal. The goal was not to have 0 cases and not have one person die. We knew that was never going to happen. There was always going to be illness. There was always going to be people dying. The models predicted, 60,000, 200,000, who knows where the actual number is going to end up. But we knew it wasn't going to be 0. But it seems like now we're taking this turn where we don't want to restart until every number is back to 0. And we just don't feel like that was ever part of the program from the beginning. It wasn't part of the goal. And it's really not how we should be looking at this in the grand scheme of our entire lives and hospitals and the economy and everything else. We have to find a way to function with this around, because even if there's a vaccine, there's a flu vaccine, there's a whole bunch of vaccines out there, and not all of them are 100% effective. So we have to get back to, we've lowered our curve, hospitals can do what they need to do, and we have to start moving on. Next headline, corona cases show it's too soon to reopen. And maybe that was the case back in early April, but if we look at the weekly positive test cases for Florida, North Carolina, California, Texas, Georgia, all the big names in the headlines that have been reopening, they're near 5% of weekly positive test rates. And we saw their testing has increased dramatically. So when we look at those 5% weekly test rates coming down, and we're at 90+% hospital capacity, that tells us it is time to get on with our lives. Doesn't mean we release all our restrictions. Doesn't mean we don't wear masks and do the right thing. It doesn't mean certain concerts, events, and things like that with crowded spaces should happen. But we have to start moving on with certain aspects of the economy for sure. 90% hospital capacity is incredible. So we should be doing what we can to reopen. Now, that's not the case for everywhere. So here are some places, a lot of states, 18 states that have a 10% or higher positive test rate, and a look at the hospital capacity. So if we look at Connecticut, for example, their weekly test rates are 18%, and there's only 25% hospital capacity. My opinion tells me not a good idea to open. Now, you look at Nebraska, very high positive test rates, 22%, but their hospitals are empty, 97% capacity, don't have population density, can still put in distancing measures and be mindful of what's opening. But if you have 90% hospital capacity, you do not have a medical crisis where you cannot provide for your community. And we think these things just need to be taken in case-by-case basis. One of the main reasons for our feeling on this is no surprise. Job losses have totaled higher than any period in the last almost 100 years, I would say. Getting close, maybe even surpassing the Great Depression when all is said and done. And we're also getting to the point where, was the stimulus enough? Do we need more? If we need more, who pays back that $6 trillion? And how long do we keep this going before children can't go back to schools and parents can't go to work because children can't go back to schools, and small businesses can't open because unemployment is too generous. There's a lot of moving pieces here, but if you have empty hospitals, you have significant testing, you have a plan in place, we've got to get back to bringing people back to work, bringing our children back to school, and starting to reopen. Another great headline that we saw, not sure where it came from, but South Korea's coronavirus wins dim after a rash of new cases. Oh my God, look at all these cases. That yellow circle is based on this article. That to me does not look like this massive breakout of cases. So again, media has great reporting in most environments. Most outlets do try and do their best for proper journalism, but this is their job. Their job is to get viewers. Their job is to excite and make everything bigger than it may seem, good or bad. So it's easy to fall victim to this. It's easy to listen to our friends or listen to someone's opinion and take it as a fact. But, this is the data. May 9th is not this massive rash of new cases in North Korea when you look at their entire chart. The next section here is something City National Rockdale does very frequently. Every month they update, and they have their team of researchers looking at different areas of the market and the economy, and they call them speedometers. So right now on the top, the equity market, there's stock markets. Fear has come down a bit, so you're not seeing 4%, 1,000-point moves in the market every day. Maybe you're seeing 200 points or something like that. Conditions haven't really changed much. And for valuations, stock markets turn negative, meaning it looks like maybe the stock market came back a little too quickly, and we need to see some support in how companies are reporting earnings, some more safer dividends. And we just think that at this level, there could be some risk to the downside. In the credit markets, so this is bonds, this is the functioning of the government and the Federal Reserve. So credit, not great, kind of in the middle, leaning towards the left. This is just a function of the risk that, given the oil pricing issues, given local governments running out of funding, potential bankruptcies for airlines. So there's just some uncertainty here. Luckily, in that middle green section for monetary, the government, the Federal Reserve, has pumped enormous amounts of money into the market and provided zero interest rates. And liquidity, again, same thing. Still a little tight, but heading towards positive, given what the Federal Reserve has been able to do. So City National has looked at a McKinsey study. McKinsey, the well-known consulting firm. And these are 9 different scenarios that McKinsey has studied of how this recovery will work. And you've heard about the V recovery, a U, a W, we're going to retest the bottoms, or an L, we're just going to drop and flatline for a while. And so based on how the virus spreads, how the government responds to it, and how companies weather the storm determines how fast we will come back. So right now, City National looks at the green boxes as a higher probability, which look more like a Nike logo, a little swoosh. But based on how things play out, it could be any one of these. We would obviously like to remind everyone, over the last 100 years, the market has always come back. We don't think this time will be any different, but how it looks and how long it takes is still unknown. This next chart is just amazing to me. In the US, I think the mortality rate from the virus is around 5%. It's probably a lot lower if we could actually test and know all the cases that are out there. But for argument's sake, whatever the number is, it is. But right now, based on a survey that was done from the Harris poll. 51% of people, if you asked right now if they think they got the coronavirus, they would live or die, 51% think they would die. And that is just astounding to me. There's so much fear. And even, the doctors and the news has made it very clear that underlying conditions, elderly, all these specific cases elevate your risk. But now you just take two random people and one of them thinks they're going to live and one of them thinks they're going to die. And that to me is part of the issue with trying to restart and trying to see where the market is going to head, because this fear has to come down for us to have a meaningful recovery. That was very interesting to me. Just look at a few other charts. So here's the S&P 500 multiple, which just means what the market's valuation looks like, what you're paying for. So we look back in 2009, the market was down to a multiple of around 10. Right now, the market is up around 20, 21. Just means the higher the number, the more expensive the market. So we're definitely overvalued here, and similar levels we're seeing back in the late 90s. Doesn't mean we're going to crash tomorrow, but it looks like you might get a better price in the future. Just depends on how earnings shake out, how companies sidestep this virus or weather through it, and what the big institutions and money managers actually deploy in terms of their cash. So the last thing, we just have some disclosures here. I'll leave these on the screen. Everyone can see them. And we'll go through a couple other slides that I think are very important. So the next one, this is from Vanguard. Again, just wanted to play on this behavior aspect. The headlines and whatever happens yesterday or last week should not dictate how you invest. It doesn't actually reflect what's happening in the market. A lot of times the media, they try and pick something that seems to make sense or is a large enough event that may look like it's moving the market, but that is not how we should be investing. Recoveries don't go in straight lines. The market came back 20% in April, was down 35% before that. If we ever get back soon to S&P 500 at 3,500 all-time highs, it's probably not going to be in a straight line. So we just have to be mindful of that. With that, we want to remind everyone that some of the best days in the market happen after the darkest, worst days in the market. So when the market has an awful day, it's keeping you up at night or you're sick to your stomach, the worst thing that you can do is sell out of a position. The worst thing you can do is to not be there for the recovery. So if you want to try and time the market, good luck. It's been proven hundreds of times over that it's a losing strategy. We take the approach where we have an allocation, we have diversification, you will be invested, but you may have some cash, and we may raise cash from time to time to take advantage of different points in the market, but we do not pull out 100%. We do not make massive shifts into your risk profile because we don't want to miss the best days. And we want to make sure that we don't let fear and emotion drive our strategy. And so here's a quick look at what happened back in 2009 to 2011. March of 2009, this was the actual bottom when the market was down 50%. And all these different headlines: total job losses top 5 million, jobs report shaky, Fannie Mae needs 15 billion more, home foreclosures record high. All these articles that came out, and the market was up, you would have doubled your money. The market was up 111% in that 2-year period. So this is just an example, and this is what happens in a lot of these severe cases where the market is ahead. The market is thinking about next year. The news is thinking about today. and what happened yesterday. So we don't want to let the market dictate where we are. Similarly, here's another few charts going back to some of the major market crashes that have happened. We have the Great Depression on the left, a massive bear market that happened during the beginning of World War II, and the dot-com crash, 9/11 events that happened in the early 2000s. So this, we want to make sure everyone is aware that we want to avoid the thought of missing the recovery. So in 1929 to 1932, the market dropped 80%, maybe more. I don't know the exact figures, but these green sprouts are what we call bear market rallies. So the market came back 48%, 23%, 29%, 35%, 25%. All of these massive moves up, recoveries, happened on the way down. They all were followed by more declines. We're not saying that's going to be the case here. Now, we think this is different because this is government-forced shutdown. However, we just want to make sure people are aware and clients are aware that the market came back 20% in April. That's not the all-clear sign. It may be. That may be the bottom, but it very well likely could be just a bear market rally where selling is exhausted. Some institutions have to buy. There's rebalancing. Traders are trying to take advantage of the market. The computer trading takes advantage of signals and decides to buy. But we would not be surprised if the market dipped down again based on unemployment levels, based on complete uncertainty of reopening the economy, and based on stimulus packages and the Fed actually being able to get through this because they don't have a playbook for this. They're doing everything they can to figure it out, but there is no playbook. So April was a great rally. It kind of brought some peace of mind back to everyone when they looked at their statements after the first quarter nightmare. But we don't want you to think, we missed it, or why didn't we get back in and have those biases that we talked about before, because this is not the entire pandemic wrapped up in 3 weeks or 2 months. It just doesn't work that way. So just wanted to make sure everyone's seeing that and understanding the dynamics of the market. Lastly, one of my favorite charts from BlackRock is talking about being disappointed all the time with how we invest in the market. And a lot of that has to do with the news always looking to show us the S&P 500 or the Dow Jones. And what happens, this is looking at the year 2000 to 2020 as of March 31st. So we see from 2000 to 2002, markets down 39%. You open up your statement, you're down 17%. So you say, when you have your meeting, oh, I can't believe we lost money. I hate losing money. Why didn't we know this decline was coming? 2003 to 2007, markets up 83%. Massive recovery. We're only up 73%. Why? Because we're diversified. We don't hold just the S&P 500. So now what happens when you see your advisor and you come in for our meetings? How come I didn't make as much? How come I'm not keeping up with the market? And this keeps going. It keeps replaying itself over and over. So that's the way we build portfolios. We don't want as much of the downside. And we know we're not going to keep pace with the entire recovery because we don't want that level of risk. So it seems like every single time you're disappointed. And we call that S&P envy. But if you look at what's happened, when you take all of that together, let's say your portfolio started at $100,000, you would have beat the market by 20 points. You would be up $275,000. And if you put that in just the S&P 500, you'd be up 254 and change. So that's the important thing to remember is by not getting all of the downside, you will win in the end. So this is an example of, a 60-40, 60% equity, 40% bond portfolio. And just wanted to give an idea because I think this is an amazing chart. It sums up everything quite perfectly about how we feel about our performance. And just keep in mind, if you think, how come I didn't keep up with the market, or how come we're losing money, just know that if you stay the course and we follow the diversifying portfolio plans and strategies that we build, we will protect on the downside and we will miss some of the upside. But when you put it all together, longer term, you will come out ahead. And that's how we like to build portfolios. So just wanted to go through these points today. Just as I'm watching it, figure I'd share. Market starts the morning down 450 points in the Dow Jones, down 2%. And by the time I finish this webinar, now it's positive again. So we just have to be mindful of, this is going to be a volatile market. We're not going to try and pick and choose the bottom and the top. We are going to stay invested, and we're going to use our excess cash to leverage into a cheaper market and let ourselves maintain our allocations where we want to be to keep our portfolios invested, strong, and built for the long term. So thank you for listening. And I just wanted to make sure everyone saw, these pages and paid attention to the facts, and not letting the news or anything that you read kind of skew your decision making, in the moment as it's happening. So thank you for listening. I hope you guys have a great weekend, and I'll talk to you soon. Bye.